The Japanese economy is no longer in the world's top 3.
Japan's fertility rate has hit an historic
1990
low.
saw the key Nikkei index in Tokyo suffer heavy
There are a
losses.
lot more people out there needing care as opposed to the people who are earning the money to make that care possible.
The year was 1945. Japan had lost World War II. Industrial output fell to 20 to 30% of pre-war levels, leaving factories idle and millions unemployed, while the cost of living skyrocketed as hyperinflation wiped out savings and made daily necessities unaffordable. Fast forward to the 1960s, and Japan had done the impossible. In 1968, Japan's gross national product surpassed that of West Germany, making it the world's second largest economy, following the United States. It grew at an average 10% per year, fueled by industrialization, technology, and government planning. By the 1970s and 1980s, Japan had become a global manufacturing giant. Japanese companies like Toyota, Sony, and Honda led the world in technology and industrial production, dominating the global market in automobiles, electronics, and steel. In 1985, Japan participated in the Plaza Accord, an international agreement aimed at depreciating the US dollar. This led to a significant appreciation of the Japanese yen, impacting Japan's export competitiveness. By the late 1980s, Japan experienced an economic bubble, and the Nikkei stock index hitting an all-time high of 38,957.44 on December 29, 1989. The land in Tokyo was so expensive at the time, even the Imperial Palace grounds were worth more than all of California. Then in the 1990s, everything collapsed. The stock market crashed, wiping out trillions in wealth. Real estate prices dropped by more than 50%. Banks were drowning with bad loans, and the government bailed them out instead of allowing the market to correct itself. The economy never recovered. Japan entered a period of stagnation that has lasted for decades. Fast forward to 2024, Japan is still waiting for a recovery that perhaps will never come. Japan's GDP growth has remained low for the past 30 years, averaging around 1% per year. Its stock market took 35 years to return to 1989 levels, only surpassing its all-time high in early 2024 when the Nikkei broke records. Yet even this historic milestone reflects how long Japan's economy has been treading water rather than doing any kind of growth that other economies were achieving. Japan's population has been declining since 2008. In 2023, only 727,277 babies were born, while 1,580,000 people died. That's a loss of 852,723 people in 1 year. The median age is now 49.8 years, making Japan one of the oldest countries on Earth. By 2070, 40% of its population will be over 65. Government debt is a massive 251.9% of GDP, the highest of any major economy in the Asia-Pacific region. And yet Japan is still one of the richest and most advanced countries in the world. It is the fourth largest economy as of recent reports, worth $4.2 trillion. It leads the world in robotics, AI, and automation, using technology to replace its shrinking workforce. It has some of the highest life expectancy rates and one of the lowest crime rates in the world. Its infrastructure, healthcare, and quality of life remain top tier. So why do people keep calling Japan a failing economy? For decades, the world has been waiting for Japan to rise again. But what if that's never going to happen? What if Japan isn't a failure, but a glimpse into the future of all aging economies? The aftermath of World War II left Japan's infrastructure in ruins, with cities like Tokyo, Hiroshima, and Nagasaki extensively damaged. Between 1950 and 1953, the Korean War played a pivotal role in Japan's recovery. Serving as a principal supply hub for U.S. military operations, Japan experienced an influx of capital and demand for goods, providing a significant boost to its war-torn economy. From the mid-1950s to the early 1970s, Japan underwent what is referred to as the Japanese economic miracle. During this period, the nation achieved remarkable economic growth, with GDP expanding at an average annual rate of approximately 10%. This rapid growth was driven by several key factors. The Ministry of International Trade and Industry played a central role in coordinating industrial policy, focusing on sectors such as steel, electronics, and automobiles. This network of interlinked corporations fostered economic stability and facilitated efficient resource allocation. Cultural emphasis on hard work and saving contributed to increased capital for investment and productivity. By 1968, Japan's gross national product had surpassed that of West Germany, positioning it as the world's second largest economy, trailing only the United States. However, the 1973 oil crisis exposed Japan's heavy reliance on imported energy, prompting the nation to implement structural changes aimed at energy diversification and efficiency. Japan in the 1980s was on top of the world, but then came the Plaza Accord of 1985. The yen surged. Suddenly, Japanese exports were too expensive. So where did all that money go? Consequently, investors redirected their capital into real estate and stocks, fueling the biggest bubble Japan had ever seen. By the late 1980s, Japan's economic landscape was characterized by dominance of major corporations. In 1989, Japan was home to 13 of the world's 20 largest companies, including giants like Sumitomo, Industrial Bank, Fuji, and Nippon Steel. The Nikkei stock index reached an all-time high. At this time, Japan's economy seemed unstoppable, with its companies dominating global markets and its banks amongst the largest in the world. Stock prices had tripled in just 5 years, fueled by speculation, excessive lending, and ultra-low interest rates. Investors believed that Japan's economic dominance would last indefinitely, pushing stock valuations to unsustainable levels. Many corporations used their skyrocketing stock prices as security to borrow even more money, further inflating the bubble. Property prices escalated to the point where the land beneath Tokyo's Imperial Palace, spanning a mere 1.15 square kilometers, was estimated to be worth more than the entire real estate value of California at its peak. This speculative bubble was further fueled by lenient banking policies, with financial institutions offering easy credit and engaging in risky lending practices. Japan's economy became increasingly dependent on artificial wealth generated through speculation rather than genuine productivity. When the Bank of Japan raised interest rates in early 1990 to curb inflation, panic selling followed. Within a year, the Nikkei lost more than 50% of its value, erasing trillions of dollars in wealth and plunging Japan into an economic decline that it has never fully recovered from. The onset of the 1990s brought a dramatic reversal of fortune for Japan. The speculative bubble burst, leading to a prolonged period of economic stagnation known as the Lost Decade. Between 1990 and 1992, the Nikkei crashed by approximately 60% from its peak. Land prices began their decline a year later, and while the drop was initially less severe than the equity market collapse, the downward spiral continued throughout the 1990s and early 2000s. Financial institutions faced a crisis as the collapse in asset prices impaired loan security, weakened bank capital, and left banks with a bad number of non-performing loans. Initially, the banking sector suffered due to losses on stock holdings, but as the crisis deepened, new mark-to-market accounting rules further deteriorated their capital ratios. The government's response was characterized by hesitation and incremental measures. Authorities were slow to address the bad debt issue, and banks were reluctant to write off losses, leading to a phenomenon known as crony capitalism, where failing businesses were sustained through political and financial connections rather than market viability. The Bank of Japan reduced interest rates in an attempt to stimulate borrowing, but consumer confidence remained low. The government initiated infrastructure projects to spur economic activity, yet these measures failed to produce the desired growth. This period also saw the emergence of zombie companies, unprofitable firms kept afloat through continuous bailouts. By the early 2000s, Japan faced a new kind of economic challenge, not just stagnation, but a shrinking and aging population. Birth rates had collapsed, and by 2008, the population began to shrink for the first time in modern history. More retirees than workers meant labor shortages, slower consumption, and weaker economic growth. However, the economic bubble of the late 1980s had already left lasting scars. The stock market never returned to its peak, and productivity gains were limited. Japan entered the 2000s facing demographic challenges as the post-war baby boom generation began retiring, leading to a shrinking workforce amidst stagnant population growth. Then came the global financial crisis of 2007 to 2008. Like the rest of the world, Japan's economy was hit hard by collapsing global trade and market instability. Exports declined sharply, and industrial production fell by over 20% in early 2009. Yet Japan managed to maintain one of the world's highest per capita GDPs and continued running annual trade surpluses until the global recession that followed. In response, Prime Minister Shinzo Abe introduced a suite of policies in 2013 known as Abenomics. The Bank of Japan implemented aggressive quantitative easing to combat deflation, while increased government spending, targeted infrastructure and public works, and efforts to enhance competitiveness, including labor market reforms, and promoting female workforce participation were put into action. Despite these efforts, consumer spending and wage growth remained disappointingly low. By 2017, household spending had declined by 0.1%, and real wages had dropped 0.2%. In fact, wages had fallen 9% in real terms since 1997, putting further strain on the economy. Most experts agree that without deeper structural reforms or a major demographic shift, Japan's economic struggles would persist. Some economists suggested that easing immigration restrictions could help boost growth, but public resistance to foreign labor remains strong, limiting any meaningful change. While Japan's overall economy has stagnated since the 1990s, its corporate landscape has quietly transformed. The Nikkei in 1989 was dominated by financial institutions and heavy industries, reflecting the speculative excesses of the bubble era. At its peak, financial firms alone made up 23% of the index, with banks and real estate giants fueling an unsustainable market boom. Fast forward to 2024, and the landscape looks entirely different. The sectors that once reigned, financials, real estate, and materials, have significantly shrunk. Instead, technology and consumer discretionary sectors now drive Japan's stock market, with Toyota, Sony, and Nintendo leading the charge. The shift away from banks and real estate speculation toward global innovation, entertainment, and retail reflects a deeper economic restructuring. Even though it took 35 years for the Nikkei to surpass its 1989 high, this milestone does not signify a return to growth, but rather an evolution. Japan has moved past the bubble economy's failures and adapted to a new reality where tech and automation define economic strength instead of speculative finance. The past decade has only reinforced Japan's economic stagnation. While Japan avoided the extreme housing crises seen in many Western economies, it still faces substantial risks. The 2020s have been marked by low economic growth, one of the highest debt levels in the world, and increasing uncertainty. Interest rates have remained ultra-low for years, but for the first time in decades, they have begun to rise. The Bank of Japan has cautiously moved away from its extreme monetary easing policies, but any rapid changes risk disrupting the fragile economic balance. Meanwhile, the yen has become increasingly volatile, making Japan's economy more vulnerable to external shocks. In recent years, the weakening yen has helped boost exports, but a sudden reversal could spell trouble. Perhaps the biggest risk Japan faces today is the potential unwinding of the yen carry trade. This global financial strategy, where investors borrow in low-interest rate yen and invest in higher-yield assets elsewhere, has helped stabilize Japan's low interest rates. However, if this trade unwinds more thoroughly, the yen could strengthen dramatically, harming major Japanese exporters like Toyota, Sony, and Honda. This could trigger a severe recession, even if the Bank of Japan intervenes. For 4 decades, Japan has been a case study in economic stagnation, but it has maintained high living standards despite this. The question is, can this continue? With an aging population, a shrinking workforce, and one of the highest debt burdens in the world, Japan's long-term economic future remains uncertain. If demographic challenges persist and global financial shifts create new instabilities, Japan may face even greater struggles in the coming years. But perhaps Japan's story is less about decline and more about adaptation. The country has shown remarkable resilience, leveraging automation, technology, and social stability to maintain a strong quality of life despite economic stagnation. Japan may never return to the rapid growth of the post-war era, but maybe that's not the goal anymore. Instead of endless expansion, Japan is transitioning to a different kind of economic model, one that prioritizes sustainability, innovation, and quality of life over raw GDP growth. Thanks for watching. Bye.